Good morning, everybody. It's July 27th, 2026. Half this year is already gone, but we have so much to work towards too. We've been trying to schedule this episode for a long time now, and I know Trevor for a long time as well. We have a lot of stuff in common. So today we have Trevor on, and he's doing a lot of different things. I want him to talk about his latest and greatest, which he's been doing for a long time as well. But welcome to the show, Trevor. Tell us about your new venture, or we can go all the way back to your high school years, whichever you want to start.
Sure. Thanks, Tim. Thanks, and I appreciate you having me on the show. Let's just start with the current order of business. I'm CEO of FNCR. Our company is focused on small, medium enterprise finance and really providing solutions for the hundreds of thousands and millions of U.S. small and medium enterprise companies that need finance.
Right.
And I'll tell you all about how I got there.
Right. Yes. We just had uh, somebody from Block Equity out of New York City on this podcast right before this, and they're all about small businesses helping them to get out of the problem, from SBA loans out of the MCA loans. So there's definitely a lot of need for this space. But go back to the early 2000s, if not late 1990s. What was working like before the internet age?
Well, it's interesting. My first job out of university was in New York. I think the internet kind of landed my second year of university. So we had email when I was entering junior year, and coming to New York then was a pretty interesting moment for financial services and fintech, because a lot of these banks and credit card companies were migrating off of literally mainframe computers with like physical tape that you put in for the storage
Yes. Tape.
into high-powered desktop kind of analytic computers and mini computers. And so the ability to do real-time or overnight analytics was just
Right.
hitting the scene when
Right.
I came to New York. It was actually a big part of how I got into lending.
That's crazy. I mean, you've certainly played the chief technology officer for a lot of big companies. Um, when you saw early onsets of internet, how it changed or changing financial services, what was that one aha moment that says, you know what, this really hits home. Things cannot be done yesterday, last week. It is all entirely possible now. What was your AI moment back in the 90s or 2000s?
Oh, that's an interesting question. I mean, I'm not that prescient. I was just there building stuff, and it made it
Right,
so obvious what an
right,
impact it was having on these companies. One of the first things I was deployed on was building part of American Express's small business line of credit model. They were just getting into lines of credit for small business. And they
right.
realized, oh, there's all this info we have from the charge cards of the owners of those businesses. And given new analytic capabilities, et cetera, you could go down to the merchant level, see the records of charge,
Right,
figure out who's buying what from Home Depot versus,
right,
an electrical utility or whatever. You can actually model what's going on in their business from the owner's kind of spillover charge
sure.
behavior on their
A
charge
lot of people
bill.
put their business on their personal card.
Yeah,
Uh,
and so that actually enabled us to build some of Amex's first models that did really well and ended up becoming a part of Open.
yeah,
So I think it was more just by building stuff and then
right,
watching it kind of hit and be in action. I
right.
will say though, since you mentioned the magic and dirty word I will say that the first time I thought about AI deeply was when I was kind of building all of these complicated models, and it was a real huge task to build a high quality model in a massive solution space, right? Imagine I
Right.
hand you the data set of
Yeah.
50 million card members, transaction level information going back 50 years. It's just so much information just in the bureau, in the records of charge, but then compound upon that the time series and the different
Yeah.
transforms and all the different things you could do. It's very high dimensional space. And we would spend so many weeks, months, years just model building and exploring that solution space. That's when I first got into AI. I started using genetic
Right.
algorithms to do better model building. That ultimately
Right.
led me back to post-grad work where I studied AI for some years.
Right. Right. That's incredible. Just amount of raw processing power that's required for MX back in the days to not understand, but just to update a data set would have taken probably days, if not weeks, to get
Oh yeah,
months
we
worth
would
of.
fight over queuing the jobs up, a week or a month in advance. And
Right.
if you knew certain people, you could get it like jumped in the queue. There's a whole game
Sure.
around it.
Right. Resources so precious
Yeah,
nowadays. Turn it up,
yeah,
turn it on.
for sure.
Anything is possible.
Yep.
Who was lending to small businesses other than the American Express, which became the open network back in the days? Who was servicing these small businesses? If Tim Lee wants to open up a, like a TV repair shop back in the days and needs some liquidity, who do I go to in the 90s and 2000s back in the days?
Almost everyone. I think
Ah,
banks were
okay.
doing an excellent job of servicing small businesses. This
Right.
was pre 2008. So prior to the global financial crisis and the regulation that came in, I think banks were the first point of entry into the financial system for individuals and small businesses. I think
Right.
banks had a pretty strong local community presence. They knew what was going on in their communities. They
Right.
had local underwriting teams. So you could go to your local branch and say,
Right.
hey, I need $5 million because my business is doing X, Y, and Z. And
Mm,
the local branch had a team of people who they could put on underwriting the loan and they could develop you a bespoke product.
right.
So I actually think the banks did a pretty good job up until GFC. But 2008 changed the whole picture.
Right. But American Express was not, in all the neighborhoods, didn't have the branches, didn't have the relationship
True.
managers. They made a whole business out of this small business lending, and I think they were the earlier guys that were doing just mass amount of direct mailing
Yeah,
to small businesses, right?
sure.
What was their unique angle into the small business space other than, having that American Express business card? How did they sort of combat the local regional relationship people that the bank has employed to kind of get the eyeballs of the small businesses? What was their approach marketing wise?
Yeah, I mean, I think they used credit cards. They sort of, I mean, I'm going to use this word a little bit too strongly. I'm going to say they
Sure.
weaponized the credit card as a way of kind of new relationship origination. And then they
Right.
added a whole bunch of other products and services, many banking products and services onto that. I think
Right.
even today, I would say they have such strong card member value proposition
Hmm.
and loyalty. Like it's clear that they stand behind their card members, and I
Right.
think that they're an excellent marketing company in many different ways. I mean, in the decades that I've worked with many of the different credit cards and banks. I think we've optimized a lot of direct mail and email and other kinds of campaigns
Right.
for them. And I will say they also made pretty good systematic use of models and data and how
Right.
to tune their machine. But they also had scale. I mean, even back in the kind of early 2000s, we're still talking like 30 million card members.
It's crazy.
And
That's
so
insane.
once you have that kind of scale, you kind of have enough information to know
Sure.
what your next marketing move should be.
Right.
And so I think there is a sort of incumbent advantage there as well.
Sure. Just to sort of for the common folks like me, a lot of places would say we don't accept American Express cards here. Got anything else going on? Why is that? Could you
It's
tell
because
us
in
once and
general
for all?
they charge more on
Okay.
average to the
Charge more
merchant.
to the merchants.
Yeah, than the other networks do, Visa, Mastercard, Discover, and so that's why many merchants. I don't even know if it's many. That's why there are some merchants who
No,
say like we won't take Amex. It's a pure financial thing.
they don't take it.
Yep.
But with those sort of premium charges, it comes with a lot of benefits as well, right? For American Express. dork something up, they'll refund you or something like that. I mean,
And that's, I
historically,
think, the endless negotiation that
right,
Amex has with its merchants. It's like, well, we're going to bring the volume of extremely high quality customers. Why?
right,
Because we put the customer first, and so we've got the clients that you want, but we're going to
right.
charge you for it. And
That's
so
right.
there's the rub.
That's right. We're gonna do all the acquisition for you, and when they come, they're big spenders.
Yep, yep.
Yeah. What was grad school? Where'd you go to grad school?
Oh, there's so I'm here in New York. I was running my own business at the time with my co-founders, the data-driven consulting kinds of business, and I was getting kind of a little bit obsessed with how the world of compute was ready for AI and how evolutionary techniques, so genetic algorithms, but other more esoteric and related techniques,
Right.
could be used to evolve intelligence inside of a computer. And so at this time, there are only about 10 places in the world you could go
Okay.
to study this stuff.
Yeah.
And it's funny, I didn't study computer science in undergrad. I studied aerospace engineering. So
Okay.
for me to jump into grad school, I had to convince the professors who were leading these 10 different programs that they should bring me on as a grad student. And so I did the only thing I really could do, which was studied all of their research and then wrote them directly, kind of critiquing their research.
Right.
It was a surprisingly, productive move. I think 6 of them invited me to go and visit with
Okay.
them, and a number of them offered me to come and work with them.
Others. Right.
And so one of those groups was down in New Mexico. So I went down. There's a joint program between the Santa Fe Research Institute and
Yep.
University of New Mexico
Yeah.
on what was then called complex adaptive systems, but it was basically a form of AI where the systems that you create can they can self-generate complexity. So instead of that coming from the human outsider being like, go do this and then go do this, go do this, all of your energy inside of this type of system is spent building a system that will actually evolve that. It will get smarter and
Right.
smarter on its own. Really, really
Right.
interesting stuff.
Yeah. One of the frontiers of AI research today, I read an article a couple of days ago, is the ability for AI to kind of self QA, self improve
Sure.
out of the 4 or 5 tenets that, should wake us up and say, hey, we got to do something about this. But that was research done, what, 15 years ago? When was that?
It was
When
like
you spent time thinking about it?
2003, 4, 5. That's
Yeah.
the time I was doing it.
Yeah. Yeah. And and then you were running your analytics shop at the same time on the side. Your
Well, my
consulting.
partners kind of did me a solid and
Yeah.
kept everything going. And then after a few years of the program, I came back and I actually brought some of my peers to come work with us back in New York.
Right. Right. So, did you come back right before 2007, 2008, the meltdown?
Yeah.
What was that? What was it like? Tell us, ground zero. Tell us what was it like during that pivotal moment, that 14 months, of '08, '09, maybe all of '08 and early 2009. What was happening on the street there?
Well, yeah. There's a lot of
Opportunities, I'm
there's a
assuming.
lot of sort of mental and real bloodshed, to be honest. But certainly there are a bunch of opportunities that were birthed in and around it. I I think this was the moment
Hmm.
that I started cluing in to how much the banking industry would change. And I honestly couldn't have predicted all the ways in which it did then change. But when regulation came in as a stopgap against future sort of 2008s, it had a particularly unexpected effect, I think, on
Okay.
small business lending. So, what happened was obviously when there's a crisis like this, the regulators they tweak a number of dials that they have access to. One of
Guardrail to
those,
guardrail.
yeah, one of
Yeah.
those dials is how much kind of physical cash does the bank need to have? What are its capital reserves against a loan? because, you know, when banks are massively over levered, then the downside of an adjustment like this is huge and hard to control.
Yeah.
But if you increase the capital reserve requirements that a bank has, they make less money on the loan, right?
That's
Because
right. Yeah.
they can't lever their capital as much. So that's expected, and that's sort of explicitly part of what the regulators are saying is stop being so speculative. You know, hold more cash. Fine. But they also kind of prescribed a number of other things that up until that point hadn't been mandatory for all forms of small business lending. Things like personal guarantees, things like very explicit time periods where if a business doesn't make a portion or all of its payments, then it goes into delinquency. Things like what happens with the paper once it's in delinquency. When do you have to
Right.
foreclose? When do you have to get it off your books, et cetera, et cetera. And all of those sound logical and normal, but put together, I think they created, they removed a lot of the ability for a bank to come up
Right.
with a bespoke lending solution for a small business that fits
Right.
the needs of many different kinds of businesses. Some
Right.
businesses are super seasonal. They would break their
Right.
loan covenants just by the regular way they do business. Some,
Yep.
you know, personal guarantees, that's another one. Many businesses, after they've achieved a certain size threshold, it makes absolutely no sense for the owners to
Right.
personally guarantee the loan. I mean, all the value is in the business. And if the business
That's
is
right.
already the collateral and you're pulling a $10 million loan against your business, does it really help if you go after the homeowner's house, of the business owner's house? Like,
Right.
you know, it's like, why
Doesn't
do you
make
need these things? And
Right.
so these were kind of mandated by regulation, and it's understandable why. But
Right.
there's some unexpected consequences, and one of them is that small business lending became quite commoditized. Once the regulators define every dimension of the product, it's a commodity, and so the
That's
only way to
right.
win in a commodities market is price.
That's right.
So now you enter a really interesting period that
Who was
kind
the
of makes
winners and losers out of that whole time?
well. I would say the banks generally lost a huge amount of share of the small business client network. And it's weird because banks spend all this energy trying to acquire consumers, and also they're pretty constructive during early stage business startup in many different
Yep.
ways, SBA program, et cetera, et cetera. But then when businesses kind of outgrow the bank's natural ability to write a loan, which in today's world is, I would say, somewhere, you know, it depends on the bank and the situation or whatever, but somewhere between $1 and $5 million, a bank
Right.
like of lending need of financial
Yep.
requirement. A business typically outgrows the capability of its bank to serve it. So great, now you have this sort of perverse problem where your best customers whose businesses grew, you can't serve them anymore, you lose them.
Right.
And
Right
then
between the big commercial banking side and then
and then
retail
big commercial
business,
doesn't
right?
start up again until you're at like 40,
20, 30
50 million.
Right.
So all of this productive sort of growth where these are businesses that made it, arguably, right? I mean, they
Right.
have real revenue, they can support real debt, they've taken care of all the early stage startup risk, they're on their way. Now you lose them, and then you hope
Right.
you acquire them again.
Right.
And so that's I think a big loss on the part of the
Right.
banks. Not their fault, by the way, but
Right.
a sort of outcome of the chips falling like this from the way regulation came into force. And the winners have been the private credit markets who came in to meet the need. And so
Yeah.
now, you know, unregulated lenders are not subject to the same regulatory constraints. They can write a loan that actually makes money productively, and they can shape it, they can shape the product in a way that makes sense for the business. And
Right.
so it's actually a better product in many ways for that business. But the rates are a
Right.
little bit higher because, I mean, the benefit of the regulator is you get super low costs of capital, right? So that's the
Yeah.
trade. But I think for most businesses, rate is not really the thing they're optimizing for.
Speed, access to liquidity, right?
Speed,
So,
access, and ability to use for growth.
right. So tell us about OnDeck, Kabbage, and Capital, if I may, and maybe to a certain extent, SoFi Lending Club's business unit. How do they come about or to emerge out of this like vacuum.
Yeah, so I would
Like,
call these
frankly,
guys
yeah.
sort of the first real like scale data driven marketplaces for
Hmm.
small business lending, and I think they have generally done a great job of serving the part of the market that can be served from
Right.
a data driven, kind of highly automated model underwrite. And having built many of these models before, you know, it maybe goes without saying, but maybe it's worth saying it. The small and medium enterprise business world is one that, from a loan or lender or an underwriter's perspective, has the
Right.
worst ratio of information to risk.
Mm.
So if you think about the spectrum of lending going from a consumer all the way to a public company,
Right.
consumers, you have all this info. You've got a credit bureau. You've
Credit
got three, in
reports. Yep.
fact. You've got all this stuff that and all these models have been running for decades, and you can really use the sort of numbers to dial in the risk, and you can do a pretty good job of a consumer loan, again, up to a certain dollar amount.
Yep.
In the public markets, you also have all this info. It's highly regulated. Everyone has to exactly, gap
Report.
accounting principles,
Yep.
every kind of filing, et cetera. And so you're also pretty information rich. The small medium enterprise land is one
Yep.
where there is no bureau. You know
Right.
this really well, Tim, more than
Yep.
anyone. There is no normalized set of information. Different companies keep their books in different ways. They're not all
Right.
forced or required to use the same accounting principles.
Yep.
And so there's all of this heterogeneity and really actually just missing information.
Mm.
And so if you're trying to write a business a kind of 1 to 10 or $30 million loan, you
Right.
have to put a lot of energy into the underwrite. So these platforms you spoke about, they
Right.
did a really good job of servicing, I would say, the below $250,000 part
Hmm.
of the commercial business lending market pretty well. And long story short, I mean, I'm sure the heads of risk at these companies would, I don't know what they'd say. I'm interested. If any of them are listening, let's have the convo. But I think, basically in my mind, it's sort of like a glorified credit card underwrite. You
Sure.
can kind of use a lot of owner bureau information.
Right.
That
With
stuff
the cash
kind of
flow.
will get you to a few $100,000. You augment it, of course, with everything you're learning about the
Right.
business. If you can plaid connect to the bank accounts, that gives you a good amount of info that you can use on cash flow, et cetera, et cetera. And I think those solutions work pretty well up until about 250. Many of
Right.
them are trying to push their envelope up to about a million, but when you really talk to them, I don't think any of them have really succeeded in sort of at scale and in an
Right.
automated way, getting
Right.
above kind of 250, maybe 500.
Right. Right.
Why? Someone has to do expensive work once it gets to like $1 million, right? And
Right.
so there's this really interesting problem. Well, I find it very interesting of between $1 and $30 million. If the banks don't kind of make that much money on it
Right.
because of the reasons we've discussed, if
Yep.
these data-driven platforms don't make that much money on it, then so how do you do it?
Yeah. So we're gonna get to that real quick, but let's go back to the other big reset, which is where we kind of met during the 2019 COVID era. Small businesses almost got eviscerated again. More policies, and the United States government and a lot of other governments around the world sort of put their hands back into small business again, just like 2008, 2009. We worked together on a couple of things, but let's talk about this when you saw that coming, the freight train coming in 2009, 2008, when the first case came out. What was in your head? And eventually, what led you to formulate this new business that truly, really helped small business get off the ground? Tell us, tell us, give us that movie script.
Well, so
November 2019, or was it?
yeah,
No, it was November 2018 and early 2019.
sure. Yeah, when COVID hit, I was actually living down in Miami, and then
Oh,
returned to New York right in the middle of it. And well, obviously, the entire world changed overnight,
mhm.
and in the U.S. in particular, I had a couple of observations. So one, the segment, if you want to call it, of the economy that is composed of the small and medium enterprises, across America, it became pretty obvious that that is the segment that employs America. I mean, we all know the numbers, but when the doors are shut and everyone's twiddling their thumbs, it becomes
Small
pretty
businesses.
obvious. Like,
Yeah,
wait a second, you
yeah,
know, this, you know, it's funny. We use the words "too big to fail" to talk about individual large corporations, but
right.
in a sense, this segment is like kind of
Too
half
important
of
to
the
fail.
employment of the
Yeah,
country, and it's too big to fail, which is why the government has to step in these kinds of moments because
right,
the underpinning of the economy, if arguably half of it is this like conglomeration of all these different businesses.
right,
There's this multiplier effect that works its way up through the economy,
right,
and I think it's not a surprise that the U.S. made the biggest kind of credit concessions to the small business segment of any country,
right.
and some of our common friends started businesses to take advantage of helping those
Sure.
small and medium enterprises connect to those credits.
Right.
So my kind of business relationship to that was to try to think of ways to accelerate cash flow to those
Right.
businesses.
Right.
So you could be a business that had a credit coming, maybe, and maybe the credit was $1 million, but you didn't exactly know when. Everyone was still trying to figure out what's going
That's right.
on. The
Right.
IRS was processing a lot of these things. They didn't have enough
Right.
agents, et cetera, et cetera. And so there's
Right.
just a lot of uncertainty around it. And a business can't do much with $1 million that may or may not be coming a year from now. Like
Yeah.
you can't do
Yeah.
anything. You can't hire someone.
That's
You can't go like grow. You just don't know what to
it's
do.
day to day, week to week.
Yeah.
Yeah.
And we had this realization that whenever there is a receivable, like a credit coming from the government, this constitutes a kind of instantly minted new asset that the business didn't have the day before. And
Right.
so, if that's the case, then the balance sheet of the business looks better, and maybe you can underwrite it for a better loan. Obviously, business, day before didn't have an extra, whatever, $2 million of credit coming, and the
Right.
day after it does. But you have to
Right.
understand now, how am I going to value that asset? It's not in your bank account yet. So,
Right.
is there a discount rate, or, how do I think about it?
Sure.
So, I built a platform to lend against those credits
Right.
that involved a number of private credit lenders
Right.
who had some familiarity with government risk, so they kind of knew how to price and
Hmm.
understand it.
Right.
And we
Right.
actually ended up making a very productive market where businesses that had government credits could either get a loan against them or could just sell them to as an asset and get it
Right.
off their balance sheet, and someone
Yep.
else would take the collection risk from the
Some people buy 90 cents, 80 cents on the dollar, just to they can hold on to it,
85 cents
whatever.
on the dollar is
Yeah.
actually how the market got made,
Right.
which is a great trade. If you're a business sitting
Yeah.
there being like, well, I don't know what to do with $1 million
Cash
that I may or
today,
may
gotta
not get, but I know what to
right.
do with 850,000 right now, right?
Right.
I can go deal with these debts, or I can go hire these people, or whatever. And so that ended up being enormously productive, and ended up becoming our business model for
Right.
FNCR, attaching to businesses that kind of they themselves have tens or hundreds of thousands of small business relationships, and where we can supply a finance or a lending solution to their
Hmm.
clients. So in this company where we met, that we were talking about, this finance solution attached to an existing base of small businesses that
Right.
had all of these credits, and we figured out a
Right.
good solution for them.
Right. Right. So just for our audience, right, it wasn't paycheck protection plan, which I think would have money, but this is employee retention credit, where it's a credit coming to you, uh, which works a little bit different, right? Why, what the differences are, why we go from the one to the other, and what that's FNCR is now. That's kind of related to borrowed same kind of concept. Already evolved all get lost in the air. What was about that? Why are there different programs? Back
I'm sorry, Tim, you cut out a bit. What you're saying? Why are the programs what?
the PPP, ERC,
Yep.
you focus on one, not the other. Tell us the difference, and why are there so many different programs back in the days, created by the government, and also there are new programs now, right? With from the government, the big beautiful bill created a bunch of stuff. Uh, there's some R&D credit that's being renewed or not renewed and things like that. So there's just mass confusion out there on why there's so many programs. Who's going to take care of it? Do I call my SBA, a liaison? What's happening now, and why is government constantly involved in creating these programs?
Yeah, I'll give you my perspective on it. I've never been a politician, so I'm not on the inside of a lot of these
Sure.
conversations. But I mentioned the word politics because I do think it has a role to play in the birthing and bringing to market of these different
Right.
credits. But the big picture here, I think, is kind of where we were about 5, 10 minutes ago, which is this sector is too important to fail.
Right.
So whenever there's a perturbation in the economy
Yep.
that can have a huge potentially negative effect on this base of the economy, the sort of one easy solve, easy,
Pump the liquidity.
yeah,
Pump money.
is to pump money into it. And interestingly, if you analyze the last about 15 years of government stimulus into the small business sector, the what it looks like is the space kind of partitions between what I would call evergreen programs that happen all the time,
Yep.
things like R&D credits, but also various forms of government-backed funding or grants like SBIR, STTR, certainly the SBA program in its various different forms. And those happen all the time, and a huge amount of money goes out every year via those kinds of programs. And then I think the ones that catch everyone's attention are the types of things you spoke about.
Right.
These kind of incident response type of credits, and sometimes they're like natural disasters, like FEMA credits, and various
Right.
different things to help businesses recover. Sometimes they are economic disaster related, think of opportunity zones and things like that. But sometimes they're just to help businesses deal with the unexpected, as happened during COVID.
Right.
Currently, there's not completely dissimilar type of reimbursement, I guess, out there called tariff refunds. So, the administration created all these tariffs. The Supreme Court ruled the tariffs were unconstitutional, and so now the government has begun to pay back a bunch of these tariffs that were charged. And so
The
again,
hundreds of billions.
you're in this situation where business now suddenly has this newly minted receivable in the form of a tariff refund that
Right.
didn't exist half a year ago or a year ago,
Right.
and that
Crazy.
presents another opportunity to get the business the money faster.
Right.
So why does it happen? I think it's a mixture of the economy. One of the levers that the Fed and Congress can pull to stabilize the economy involves direct stimulus. It's injecting money into small businesses that are at the base. And if deployed well and the right anti-fraud and KYC, KYB and all of that are followed, then I think it's actually a pretty good measure in a sense, in that it has a direct impact. It flows
Right.
back up through the economy
Right.
almost instantly. That also arguably means it can be made more directed and efficient because it's directly stimulating. In other
Right.
cases, I think it's like almost purely sort of geopolitical, like tariff refunds. I don't think are direct stimulus anything.
Yeah.
It's
Yes.
sort of like someone changed their mind.
Somebody will still have to deliver all of these credits and funds, right? Just like Medicare, Medicaid, they dump a bunch of money to a private enterprise, and they deal with doctors' offices and all that stuff. So this is when the economy is sick, right? It needs to deliver all these refunds to get the economy healthy again.
Well, you put your finger on something like pretty interesting, which
Yeah.
is that the government itself, given that these types of credits
Yep.
may come from different departments, different divisions, different, state or federal kind of governmental bodies.
Right.
There isn't really one system or clearinghouse for all of it. And when the government or Congress or a politician announces a program, they may not have inside of the program's budget marketing
Right.
for the
Right.
actual program, education to let people know that it
Right.
exists. And so you're right, it has become kind of the purview of the private markets to figure out how to
Right.
help businesses take advantage of this complex landscape of credits that is completely dynamic. And I think it probably will continue to be that case until and if the Fed decides that it wants to unify the way that it does this kind of stimulus.
Yeah. One of these days, one of these. But they have money. We need to help them to disseminate this stuff. But let's talk about FNCR. First, tell us about this acronym. What does it mean? And the question to you is, why should FNCR exist? It's a whole crowded market that caters to small business.
Sure. Well, FNCR is just shorthand for financier. It exists because small and medium enterprises do not have a financier. If you think about in today's world, we talked about pre and post GFC, et cetera. And if you think about what the kind of advisory needs a business has generally, I think they're kind of legal and accounting and finance are three of the big ones.
Yeah, maybe
People
they have
usually have a lawyer and
accounting.
accountant, but who's their financier?
Right.
I think back in the day, it used to be maybe their local bank manager, but maybe that was kind of 15, 20 years
Well,
ago.
today they get bombarded with all these analysts from PE firms. Oh, you want to sell your business? This. The problem
Sure,
out of the
which is
business.
completely different than someone who's occupying a position of being your advisor as to what
Right.
market terms are given
Right.
your business's situation.
Right.
And what I learned in the first scale lending program that we built, and you were a part of that, was that the need for this role isn't just in and around government credits. It's around every kind of finance in
Right.
this 1 to 30 million sort of finance range.
Right.
I think we've already sort of said it. You have a financier up until kind of $1 million, let's say. Let's be generous, which is a
Yep.
combination of your local bank and these platforms or whatever. You have one again above 30 million. It's the
Yep.
commercial credit department of any
Yep.
one of these big banks.
Yep.
So who is it in between those two things?
Nobody.
And we realized this is a missing role in the economy right now, and no one had really tackled head on the challenge of how to deal with the expensive, relatively information poor, like kind of related to the risk, and extremely heterogeneous space of lending to $1 to $30 million tickets into these SMEs. So we created this company to solve that problem.
Financier. Well, there are so many different variations, so many permutations, like you said. Every business's need is different. Different businesses, different everything, right? Life cycle of the business, different partners, owners, they're at different stages of their life. How do you keep it all together and make it scalable? How do you get into the minds of these small business owners that are trying to grow, in that vacuum of service, right? They clearly need something, top line, bottom line, whatever it might be, right? They don't have a CFO, right? They probably barely have a bookkeeper outsourced. What is a client of FNCR enjoy? What would they get when they work with Trevor and the team?
Sure. Well, to answer that question, I'll first lay a bit more background about how the market actually works today. We talked before about the banks kind of exiting stage left, and generally there are some exceptions, and there are some types of businesses that they're still really good service partners for, and that's
Yep.
mainly because the whole relationship pays them, even if the loan doesn't
Right.
pay them.
That's
And these
right.
tend to be like doctors and dentists and
Yep.
veterinarians and things like
Yep.
that. But outside of these sort of specialty groups, they're not, they're just not geared up to and don't want to solve this problem. On the private credit side, though, really starting about 15, 20 years ago, individual non-bank lenders started filling this gap that was left by the banks as they started kind of retracting from this kind of lending strategy. And what's super interesting is you put your finger right on the hard part of the problem here. It's heterogeneity. How do you deal with different industries, different sizes, different kinds of balance sheet, different kinds of cash flow, different cyclicality, different events in the life of business? I'm
Right.
acquiring something, I own
Different
real estate,
outcomes that these
selling
people are thinking
it.
about.
Yeah,
Sure.
all these different things. And it's not just how do you deal with it from the perspective of keeping it all straight in your head and deciding what to do next. It's also how do you deal with it from the perspective of developing a loan underwriting tape that fits that situation, that allows you to know predictably what your loss ratio will be, and so it allows you to price it. It's very, very complex space, and I don't believe that space and that problem is going to be solved anytime soon by one actor. I think, if you kind of do the back of the envelope math and you think about how much capital needs to be deployed through a machine that handles all of that complexity in order to gather the data points that let you build the model correctly, I
Right.
think you'll come to the conclusion, as I have, that it's not going to happen through kind of a one balance sheet strategy, not in the near term.
Yeah.
So paradoxically, think about what's happened over the last, say 15 to 20 years, as the private credit markets have increased their lending into this space.
Yep.
Being, non-bank lenders, what has, I think, very organically happened, and it's logical, is people have hyper specialized in just one kind of lending solution or one kind of need. So they don't, for instance, lend to every industry. They only lend to dentists. I can think
Yep.
of a very successful example that did just that and did it very
Yep.
well. Or they don't lend for kind of non-real estate exposed businesses. They only lend on real estate.
Yep.
Or they have a specific rule. They're only going to deal with businesses that are between like 5 and 8 years in
Right.
existence and only with
Right.
this revenue curve. And they all learn different pieces of this very complex puzzle, and they develop the tape to do that part well.
Right.
And then they can do that well all day long. The
Right.
issue, though, is that when you're super niche-y like this, you don't have a huge lending facility or capability generally.
Sure. Yep.
And so you don't become some massive bank and you don't have a huge kind of origination machine. You might be sitting on $500 million to call it 10 or
Yep.
20 billion
Yep.
dollars, and
Yep.
that's great. You're rotating it through, but you
Yep.
don't have 100 people sort of that are your employees that are
Sure.
finding these deals and really kind of sourcing them from the lender's
Right.
perspective.
Right.
And so what happens is these private credit lenders who serve an increasing share of this market, they basically use brokers, like human physical brokers who pair up with two or three of the lenders, and they go knock door to door, they call around in the local town that they're in, they meet people, and
Right.
they originate deals. And so,
Right.
kind of that's where we are in 2026. A huge amount of businesses find capital through a broker that found them and works with a couple of these lenders. And I don't think that there's something beautiful about this in a way. The rub is that it's a pretty high brokerage commission that
Sure. Yeah.
the lenders pay,
Yep.
and that the borrower is ultimately paying, kind of,
That's right.
in the interest rate and all of that. And it sort of tells you that the origination, the finding of the right deal, is kind of the big problem in this space.
Right.
And so we decided to create the platform that connects the about 2,000 sort of bank and non-bank lenders that are in the U.S. serving this space to the about 2 million businesses in it. And we do it pretty systematically. So, frankly, we don't have our door open for, like, our shingle is not kind of open at scale for any business in any stage, in any part of this space. We're very intentional about mounting what we call programs and defining a space that has a real need and a subset of those 2,000 lenders who have a real solution for it. And we've mapped the space out. There's kind of, I mean, we've chosen 7 dimensions to describe the space. We know every capital provider in the space. And we partner, like I was telling you before, with businesses who have generally more than 50,000 small and medium enterprise relationships. And these businesses are large suppliers or things like PEOs or, in healthcare, GPOs, people who have huge numbers of contractual relationships. And I keep using the word relationship because it's not just about data, it's about a real relationship with the founders or owners of that business. We become their embedded lending capability to their customer base.
Gotcha. Wow. These programs, 7, all so it's a multivariate data site between these complex businesses that have deep relationship and banks and partners, private credits are looking for this. You guys are serving as that heritage, right? Saying, hey, here's
Yeah. Well,
wow.
let me clarify what I'm calling a program. So I create what I call a partnership with someone
Okay.
who has, tens or hundreds of thousands of these businesses. There might be very different or similar segments of businesses at different stages, all this other stuff
Yep.
going on inside of that customer base. A program is what I call a cohesive need by a similar segment. So within someone's 100,000 SME universe, there could be 5 or 10 different programs. So that's how we kind of map the way that the markets have understood how to lend to the demand that's out there. We kind of create these widgets, if you want,
Sure.
programs I call them,
Yeah.
and they're a segment of need that 5 to 10, for instance, capital providers would all want to lend to. And so then we make the matching problem
Yeah.
a little bit more well defined and systematic. So as opposed to kind of handling, the same
Here's six
person
months of bank
handling like
statement. Let me
purchase
know what you get.
reporting, heavy equipment manufacturer midday,
Right.
and like, a massive hospital system in the evening. Those could each be different programs within our
Sure.
universe that we've intentionally formulated, and we reach out through the existing relationships to match solution to need. So one of the important things about this whole model, I'm a many time founder. I know how scarce founder time is, and having been on all sides of this equation with various different banking institutions and
Yep.
large kind of direct marketing capabilities, I really wanted us to find a solution that didn't waste people's time. And I think it's a huge waste of people's time to call them or text them or email them unsolicited. And I also think these channels are kind of asymptotically approaching kind of zero conversion
It's a
rate.
spray and pray strategy with a lot of these people. Like, give me whatever, and I'll just see what sticks out there. It's not
Yeah, and
intentional.
with AI, our ability to generate phone calls and texts
Yeah.
and emails cheaply has sort of increased orders of magnitude, which just to me means all these channels are decreasing by orders of magnitude in sort of unsolicited connection attempt. So we don't do any of that. Zero. We never market to someone if they didn't already invite us to speak to them, and we only speak to people through an existing relationship.
Right. I was going to say, probably not difficult to find capital partners, but I don't know how you guys get in front of these, medium-sized businesses, right? That they didn't know this concierge service existed. But
Yeah,
wow.
look, it's a careful relationship that has to be formed like properly at the appropriate speed with the right timing. It's a very deeply integrated relationship For this to all work, we get access to a lot of internal proprietary data. We deploy on-prem, we do all the things to make sure that it's safe. But there's a lot of trust involved in this kind of deep integration because a business is going to offer us as a solution to their existing customer. And there are kind of two big pros here. One, many large businesses that hold relationships with a huge number of small medium enterprises, they're very happy if big chunks of their customer base get better funded because they can buy more stuff, and so it makes sense. There's a real win-win here, and we share a portion of the fees that we get from the lenders. So the lenders pay us if a deal consummates. And in some cases, they pay us to subscribe to one of these programs. We will pay back a share of that to the group that has the primary customer relationship. So there's a real reason for everyone to care about this. And from the perspective of our partners, it's a double win. They get a new EBIT stream that they don't really have to do anything for, that leverages this huge asset that's inside of their data and their relationship, but carefully, in a controllable way. It's not spray and pray, like you said. And because we roll this out as a series of programs, we have total control over the speed and the velocity and who and how fast, and that builds a lot of comfort.
Let's wrap this up. It's 51 minutes. This is one of the longest episodes I've recorded. If you're looking for, if FNCR is looking for class of small business to, what's new right there? For engineering networks, doctors networks, group of folks, what are you ready to take on?
What are we ready to take on now?
Yeah, what kind of group of businesses?
Yeah, we focused so far on real estate and healthcare industries. There's obviously a huge amount of complexity already in both of those industries. And I honestly think those two sort of industry typologies are going to keep us pretty busy for the next couple of years. I think the next place that we're already starting to kind of look for partnerships in and around are going to be, the next ones. The way I pick industries is there enough data to make this not a waste of everyone's time, so you can actually home in on the businesses that need capital, like quickly and early. And I think that a next type that comes to mind are kind of e-commerce, online transaction types of businesses. There's a good amount of data and information there. And then increasingly, I do think that there's going to be a whole wave of, AI-empowered business types, even in a sense the grown-up version of the future creator economy that I think are also going to have a lot of data and information available.
The market's every day, Trevor chase after this.
Yeah.
We're interested, right? So let's build what a money wants you to build. But again, Trevor, thank you so much for being on FNCR.com with all the stuff that you're doing. Trevor's very popular on LinkedIn, so it's not that hard to find him. You want to find him directly. We're going to post all this stuff tomorrow, and if there's any questions you want to answer, we'll put in the comment section. Trevor, again, thank you so much for coming on.
Tim, thank you so much. I really enjoyed it. Talk soon.